We started this journey some 2.5 years ago with market research. There's no doubt that over the years, it's been 14 years in this sector now, that we've had a lot of research around the baby boomers, and all that research pointed to choice. Not only choice, but choice was certainly a big theme. And I came into my role about 2 years ago, and before that, I'd made a few attempts to introduce some level of choice unsuccessfully, but I did make it my mission 2 years ago to do something different. I feel as an industry, as in a sector, that we've been around for 50 odd years, depending on who you talk to, and for a long part of that time, we were a one-trick pony. And there hasn't been a lot of discussion over the last 2 days around our penetration rate, but I'm sure it's somewhere between 4 and 5%. And it's been the case for a long time. And our market is growing and our penetration rate is arguably decreasing because we're not keeping up to speed with the increase in the market. There's a reason for that, and so what we did is we went and researched existing customers, potential customers, but we also spent a lot of time chasing down customers that were going to be customers that decided to say no. And they formed part of our focus groups, and what we wanted to really get to the bottom of was what was their reason. As we know, a lot of our cancellations in our industry are related to other circumstances, not necessarily about what we're doing or what we're not doing, but a theme around the rejectors was that a lot of them don't like deferred management fees. That's not to say that the market doesn't like it, but there's a market out there that doesn't like it. And I used to think that our market, once upon a time, was our customers that we talk to, and they certainly have a perspective, but rest assured, so do their children, and we find that out in 10 years' time, not always the case. And so we're probably the only industry that I can think of that you transact with one customer at the beginning, but at the end, it's not that customer again, right? And we've always based our research on the customer, the people that walk in the door. What we did is we actually went and talked to the secondary market, which are the children. So, well, why have you? Because in some cases it was children that were steering mum and dad away from making the decision for whatever reason. So we went and hunted them down as well. So it is complex by bringing in choice, but I'll also say that standardisation doesn't go hand in hand with innovation. The more you standardise what you do, the more you stifle your innovation in your business. That's the way I feel. So we do need to keep it as open as we possibly can so we can continue to innovate. And our market is large, and asset wealth has increased dramatically, especially over the last 10 years. And people have an ability to pay that they didn't beforehand. And as an industry, we've continued to respond to that with, here's the option, it's the discount option, it's the deferred management fee. But we haven't really given them an alternative to pay more and keep more. So I'll now touch on the different options that we introduced. And I'll also say that, following the research, we undertook some pilots. So we picked a couple of villages and we further researched as we piloted to make sure that we had our story right, we had our disclosures right, we had our training right, and we had all the feedback down pat. And then we rolled it out to the majority of the portfolio it was about June last year. Our strata villages, we're continuing to roll this out to, because in our strata villages, it's not always the case that we have to, but we like to get the support of all of our existing residents in strata villages. So we tend to go through a voting process to say, this is what we'd like to do. We'd like your support. So let's vote on it as a community. And then every resident exiting has the option for us to offer the options. So if they decide that they don't want for us to offer options. They don't, they can say no, and then we won't offer the options, and we'll just offer a similar contract to what they moved into. So prepaid plan, if we just sort of round it out and say, if you compare it to a deferred management fee, which is based on a resale price in 10 years, where the resident keeps some of the capital gain, i.e. we charge deferred management fee on the resale price. Under the prepaid plan, you have the option of paying 18% as a management fee up front. And then when the unit sells in 5, 10, 15 years, whatever the case is, they get the capital gain, they get the whole lot. So, it assumes that the next sale is a deferred management fee contract, but the difference between the price today and the price that we get in 10 years' time, they keep that. And they're responsible for reinstatement costs, they're responsible for selling fees, and they're responsible for legal fees. And what it does is it basically aligns it more to a real estate transaction, a transaction that they're more familiar with through previous purchases in their life. And this customer, so when we went and circled back to what does this product respond to based on the market research, it responded to the customers that want to leave a legacy, the customers that have a bit more of an investor psyche. They're moving into retirement village for all the other great reasons that we talk about: amenity, location, friendship, care, all of that. But separately, they can go and talk to their financial advisors confidently and say, well, these are the options that are in front of me, what do you think? And some of them do choose this. There's a high level of confidence around this particular contract because in their mind, it's simple because the management fee's out of the way and the rest of it is aligned a lot more to a real estate transaction, which they quite understand. Refundable contribution is a little bit like a RAD. Now, we have a lot of customers that worry about what's next and how do I afford that and what if I'm paying a RAD. We also have customers that are selling their houses at prices higher than they expected. That's slightly changing at the minute, but it's certainly the theme over the last 12 months, and end up with more money. And if they're a pensioner, because they were asset rich, cash poor, and you say to them, here's your deferred management fee option at 500K, and you don't have any ability for them to contribute more, the reality is that they're at that point walking away from a full or a part pension. At that point, it's good for them to go and talk to a financial advisor to help them choose what's right for them. So this customer essentially buys at 30% more than the DMF price. If the DMF price was 500, they'd be paying 650. And they're in there, and if it sells for $1 million in 10 years, they get back 650 within 60 days of them vacating the unit. There's no reinstatement cost, there's no selling fee. It's as simple as that. They pay establishment fee up front to cover what may come in at the end, and that's 3% for us. But it's really simple for them. They know exactly what they're getting back when they move out. Deferred management fee, I won't spend too much time explaining that because you, of course, a lot of you are in that business. But when we disclose to our customers what the options are, we disclose all the options together. So we have what we learned through the pilot process is that transparency is really important. The disclosures are really important. And the relativity between the options is really important. And what I mean by that is that we as an industry have for many years said this is a good deal for a customer because you pay less now, but you pay at the end, but less compared to what? So what we're able to do through our disclosures now is compare what these options look like today and in 10 years, and the customer gets true transparency. So they can end up with this under a deferred management fee, or that under a refundable contribution, or that under a prepaid plan. And dare I say, most of them continue to choose deferred management fee. But what we also know is that they're more confident in making that decision because they've been given true disclosure, true clarity, true transparency around what capital gain actually looks like compared to something else, which is really hard to do that when you're comparing something against itself. Our salespeople love it because we're worried about, this is going to be complex, but our salespeople love it because there's been instances in the past where, and we heard some of this yesterday, some of the speakers were saying that, DMF's quite complicated. Our salespeople sometimes don't like explaining it. They explain it, but they don't like explaining it. Don't quite know how to explain it because the industry explains it different ways. Some people talk about, it pays for the amenity that they're moving into, and that's what it's for. Some people, yesterday were saying it pays for capital replacement. Not sure that, that all of you do that, but it's not something that we say. I've always explained it differently in saying, well, you're paying less now and you're paid at the end, and it's essentially a financing type model. But the reality is we all do it different, which means our salespeople are all doing different, which means it's harder for them to explain. Whereas this way, you say, well, explain it as you want. These are the differences. Have your choice and let us know which one you think. And they feel more confidently about referring them to financial advisors, legal advisors, because it's all there. Pay-as-you-go is something that we were a little bit gun-shy on at the time that we introduced this, because there's obviously a lot more of a capital commitment from the business to essentially have stock in your villages and then charge what is arguably a lower yield. And then some operators are able to do that better than others, depending on what their financing arrangements or what their structures are. In a listed environment, it's a little bit different. We do need to still distribute return on equity. We need to pay dividends and all that sort of stuff. So pay-as-you-go ends up being a little bit of a drag on returns if you're trying to change what you've done in the past. However, we're feeling more confident about introducing that this year. So we started off in service departments. We thought we'd trial it, and it's gone really well. And the customer demand and feedback has been quite strong for this type of product, right? So we've always talked about what the reaction to it would be based on evidence that existed, I think, 10 years ago, which was quite unsuccessful. However, we will be introducing more of this over the next 12 months as we've now dealt with some of our capital constraints over the last 12 months. So it's horses for courses. Every business is different. I think the benefit we do have, which some of you would have and others won't, is we do have scale. And so if we end up in a situation where there is one particular village that opts to one particular contract that has a different risk profile for us than others, well, rest assured there'll be another village that does something different. As it stands today, it's been a bit of an even distribution amongst the two main alternatives, which are 1 and 2. So we've not had any strong market demand for capital gain or refundable. It's been a bit of an even balance, right? But the majority of people are still reverting to deferred management fee. But as I said earlier, are feeling more confident about the decision that they've made because there is relativity and transparency that exists now that wasn't there before. Now, Robin, you had like 30 questions. I didn't keep track of them all. I don't know if they were meant for Alison and I, but why don't I give Alison a crack because you went over time and we need to make some time back.